Hello friends, today we are going to start a new series on IND AS. In this series, I am going to take each and every IND AS which you have to study in your CA final, and I am going to give you or explain the summary of each IND AS. So in this series, our purpose is not to delve into the details of the IND AS, but before you delve into the IND AS, a particular IND AS in detail or in depth, you should understand what is the summary of those standards. So we'll be taking the standard one by one, and then we will take the standards one by one, and we will see what is its summary. Okay, when I talk about the summary, I will be covering the structure, the manner in which the standard is presented. Okay, the major conditions or major principles used, and also to some extent the disclosure requirements in that particular standard. So let's begin. Now, before I move to the standards one by one, we have already discussed in one of our previous video, okay, the structure of Indian accounting standards or IND AS. But for the benefit of all those viewers who are viewing this for the first time, I am going to give you the structure again. I am going to explain the structure again. IND AS, if you see, the total IND AS can be categorized into two types. You have IND AS 1, 2, I can take it up to 41, which comes in the first series, and you have IND AS 1012, 116, and of course we have 117 also. Okay, so what is the difference between the first series and the second series? You could see how it is numbered. In this case, it starts with 1 and it goes up to 41. Of course, there are some deletions in between, but it goes in that order. Whereas the second series, it starts with 101 and it goes up to 116 or 117. 117 is not fully implemented. That's why I wrote 116 or 117. Okay, so what is the difference? Now we have already seen in one of our previous discussions that IND AS is derived from where? IFRS. And in IFRS, you have two categories of standards. That is, you have IAS, International Accounting Standards, and IFRS. Okay, IA is again the previous or the old generation International Accounting Standards. You have IAS 1 to 41. And IFRS is nothing but the new generation International Accounting Standards, International Financial Reporting Standards. It starts with 1 to 16 or 17. Now probably you will be able to appreciate what is the meaning of these naming series. So this IND AS 1 to 41 is nothing but it is equivalent to IAS 1 to 41. Similarly, IND AS 1012, 117 or 116 is nothing but it is equivalent to IFRS 1 to 16 or 17. Okay, I hope that is clear to you. Now, the entire IND AS, I have told you, is nothing but 98% International Accounting Standards or equal to International Accounting Standards, which means there is 2% change, and this 2% changes in IND AS versus IFRS. This is what is known as carve-in or carve out. So what is carve-in and carve out? Carve-in means these are additional requirements brought into the IND AS. Additional requirements mean what? these requirements were not there in International Accounting Standard. Okay, but it has been included or inserted in IND AS. Similarly, what is carve-outs? Carve-outs refers to omission or exclusion of certain requirements. Means what? There were certain requirements which was applicable in the International Accounting Standards, but when it came to IND AS, these omissions or these requirements were omitted or deleted. So that is carve-outs. Carve-in, it came in. Carve-out, it came out. It went out. Now, there are few more changes which technically we call it as not resulting in carve-out. Not resulting in carve-out. What is that? There are certain omissions, but you don't call it as carve-out. You don't call it as carve-out. Why? Because it does not affect the structure. Does not affect the structure of the standard. So even with this omission, the structure of the standard remains the same or is same as its international counterpart. So that is the third category, not resulting in carve-outs. Now, to give an example in this carve-outs, I can say when you go to the IFRS or International Accounting Standards, there are alternate or multiple accounting options or treatments which are made available. Say for example, if you see the depreciation, for depreciation you can use multiple methods. Either you can go with SLM or WDV, or you can have machine hour basis, so etc, etc. Similarly, if you see the PPE, property plant and equipment, you can either go by cost model or evaluation model. Okay, so International Accounting Standards gives alternate models or alternate methods for its applications or for its principles. Now when you come to IND AS, our institute or the government felt that in certain cases we don't want that alternatives or options, or we don't want certain options, so they omitted that. So what happens if there are two alternative, let's say alternative 1 and alternative 2 in IAS or in IFRS, when it was taken to the IND AS, they decided we don't want two, we want only one. So does it affect the structure of the standard? No, it does not affect, because it was an optional treatment. Okay, so these are the changes which are not resulting in carve-outs. So I hope it is clear to everyone. We have explained or we have discussed this in detail, but this is for your understanding. Now we will go to the standards one by one and we will see the summary of each standard. Thank you.